Awesome. Well, we have a quorum here of attendees, so I wanted to kick things off. Wanted to welcome everybody here. This is the very first event of the Raleigh Founder Institute. We'll talk more about what that means in a second. And we are so excited to welcome three investors, Lister Delgado from Idea Fund Partners, Tobi Walter from Cofounders Capital, and Fawzi Itani from Forerunner Ventures. Let's see if I can make my Zoom stuff work properly. Before we have them introduce themselves, I want to talk briefly about Founder Institute, the reason why we're all here. It's probably the largest pre-seed accelerator in the entire world. Over 6,000 at this point, probably pretty close to 7,000 alumni have been through the program, raised billions of dollars for startups now valued at tens of billions of dollars. It's a global program at over 100 countries. And it's really powered by its mentors, 25,000 mentors and almost 3,000 investors who are investing in the graduates of the program. For folks who've never been a founder before, who've never been through a fundraising effort, wanted a kind of place where Founder Institute sits. A lot of founders, first-time founders, before they even do anything else, they want to, get themselves a little bit of education. That's where a program like Startup Weekend or Y Combinator Startup School or even Founders Institute Open to Start program can lie. Founder Institute is a pre-seed accelerator, and it's all about helping you get the traction you need to raise your very first funding. There are also accelerators for seed-funded companies, Y Combinator, Techstars being some of the most famous of those. And then there is, of course, a whole world of seed funding, which if you participate in the Founder Institute programs, you get to learn all about. The way the program works is pretty straightforward. Number one is we find great people. The biggest predictor of are you going to be a successful accelerator or not is the quality of the people that you bring in, and we're pretty picky about that. But for the people who do join and who are accepted, we give them a really impressive network, which I mentioned earlier. The program that we have is structured. It's about 4 months long. Every week, there's a different activity, a different task that you go through. And for the people who complete the program, it doesn't end when you graduate from the accelerator. You get literally a lifetime of support from the program. And that support comes especially from the mentor network. Locally, we have, at this point, almost 50 local CEOs and founders who are mentors, and they complement the 25,000 mentors we have globally. The way you interact with them is through weekly feedback sessions. They teach classes and courses. They're available for office hours. And we structure the program in a way so that mentors are invested directly in your success as a founder. The core program is, as mentioned, 4 months long. And in the course of that month of weekly meetings and activities, you validate your business idea, you solidify your team with your co-founders, and you finish a go-to-market plan. If you want to learn more about it, and if you want to consider applying to join, which is free and kind of a fun process, check out our website, fi.co/Raleigh. That's Founder Institute, fi.co/Raleigh. And there are later programs as well for people who have gone through that or who are further in the entrepreneurial journey, called Founder Lab. And again, for all graduates, there's a massive network of funders as well. And finally,
sorry, I went ahead and put that in the chat for everybody too, so they can just click link over to it.
Thanks so much. Yeah. So check out your chat and you can click directly in. Before I ask Tobi, Lister, and Fawzi to introduce themselves, for people who have never done one of these Zoom webinars before, I have a bunch of questions, and I'm going to ask our three experts here for their feedback. You're going to have questions yourself as a participant. Stick it in the Q&A, and Greg and Oz, my two friends and other local, waving, are going to watch that carefully and try to bubble up some of the questions that that you put in there to the end. If your question isn't answered and there's enough interest, when this whole webinar is finished, I'm going to pop a link into the chat to a Google Meet where we can talk more casually amongst everybody else who is here. The investors probably won't be able to join for that, but it's a great chance for all of you participants to meet each other and potentially to meet some of the folks from Founder Institute as well. And with that, I am going to stop sharing. And Lister, because you're next to me, do you want to introduce yourself?
Sure. So my name is Lister Delgado. I am the managing partner of a firm called Idea Fund Partners. We are a 16-year-old firm now at this point. We are investing already out of our fourth fund. And what we do is seed investing for the most part. We will invest in pre-seed companies, and there are some cases in which we'll go to an A. But seed is the core of what we do. We tend to write checks between $250K to $500,000 initially, and then maybe $3 million over time with some of those companies that we invest initially. The focus is investing broadly. We are what I would consider generalist. We don't really have a specific sector, but we do have preferences in the investments that we make. We like B2B, mainly software. We do some hardware with some tech-enabled services. We like fintech, insurtech, cybersecurity, HR tech, infrastructure. And we tend to, for this next fund, for this fourth fund, we have sort of gone backwards towards what we were doing in our previous three funds. We've gone more smaller from a deal sourcing perspective. We'll invest anywhere in the country, but we like to source in the areas between Baltimore and Atlanta. And maybe that's good enough for now.
Awesome. Thank you. Tobi, want to introduce yourself?
Yes. Hi, everybody. And thank you all again for having me. Tobi Walter. I'm a partner with Cofounders Capital, formerly in Cary, now in Durham, North Carolina. I was a software entrepreneur for most of my life, spent about 15 years in the founder and entrepreneur seat. I did one startup in Berlin, Germany, where I'm from originally. I came to Durham in 2008 to co-found a venture here in the fintech space, sold that business in 2018, and then had to figure out what I wanted to do when I grow up, and joined now the dark side about 4 years ago. At Cofounders Capital, actually, all of us are former entrepreneurs. We focus on B2B software. That's what we have all done, and the little part of the world that we feel we know and we can be helpful in. Our thesis is ultimately we invest in B2B software ventures, quote unquote, at the earliest stages. And now we'll get into all of that a little bit during the discussion here, but we can, in fact, still do some pre-revenue investments. That would require us knowing the market intricately well. So chances are that one of us had to run a company in that space before, or we have a lot of potential buyers in our investor base that we can bounce solutions off of or the like, but there's going to be a small portion in pre-revenue. The majority will be quote unquote at revenue. So call it from 50K to maybe $1 million in annual revenues is probably what we'll max out. We typically write 1 to 1.5 million checks initially, follow on over time. And then, of course, as former entrepreneurs, our spiel is we can get in the trenches with our founders. We can get incredibly tactical. We can help you hire. We can help you sell. We can help you work on channel distribution partnerships, pricing strategies. Of course, we always get our M&A hats on in exits, or we help raise the next round of financing, and try to be at least a little bit of a co-founder in your venture, although you'll be working on it a lot harder than we will, and you'll make all decisions. The one thing we'll say is we recommend an advice, but if we would make management decisions, then we couldn't hold you accountable anymore for the success of your venture. So we'll stay short of that, but that's about us.
Thank you. And Fawzi.
Great to meet everybody. And I know it's not easy to take time in your evening to be here, so I also appreciate that. It's great to learn from Lister and Tobi as well. I'm Fawzi. I'm over at Forerunner Ventures. I originally started my career off at LinkedIn, where I did sort of a program that funneled me into a lot of different go-to-market functions. And while I was there, started my own gaming research and consulting business, which ultimately led me to Forerunner Ventures. We're a consumer firm that has invested in companies like Fair and Chime, Hims and Hers, and other brands like Glossier and Warby Parker. So I've been around for about 10 years, have $2 billion under management, and we invest anywhere from seed to Series B, and we're typically leading those deals. A lot of people think of us as a consumer firm. I'd say the running narrative and thread that we have common between a lot of our companies is just that it fits a human thesis. That is, what are modern needs and expectations, and how does it affect consumer behavior? That's mainly what we're thinking about, and about 40% of our portfolio is B2B and 60% is B2C. We have a bunch of different theses that we're exploring constantly. Lately we look at a lot of what we call digitally native franchises. Some of that also involves like upskilling and reskilling, but then more broadly in healthcare and fintech and a lot of the other consumer spheres.
Great. Awesome. It's great to have all of you. And I thought I might start off with a question that's near and dear to my heart. Once upon a time, I was a pretty mediocre founder. And I wish I'd asked this question of myself. So I'll ask you instead. What are 3 things that a founder should ask themselves to decide if they have, in quotes here, a VC scale business, kind of business that makes sense for people like yourself to invest in? And Tobi, maybe I'll kick this off to you first.
Sure, and I've been thinking about before, because I know you want metrics and numbers. I've been trying to think about before if I could come up with.
Oh, I'll get to the metrics and numbers later. Yeah.
But so my first thought on that was, maybe I would say, if you can reasonably get to above 10 million revenue in the next 3, 4, 5 years, at least for our stage investment, that'll be different for different people. But I think that the real question, I think there's 2 parts. There is about how big a venture can get, and there is the part of how much time will it take. And I think a big part for the founder is, am I okay having a clock on it? Am I okay not being able to experiment all that much anymore? But we tend to say, and it's all because of our job, right? Our job is to return capital to our investors. That will make sure that we can raise the next fund again, we can fund the next generation of entrepreneurs and startups. And we tend to say time is the fire in which we burn. It's an IRR, which makes how much money we make back to people, but also over what period of time. So typically when you get a VC in, the clock will start ticking and people start going, all right, where's the revenue ramp? Where's the traction? Where are the next milestones? How can we get you to an exit? You got to be okay with, there is an exit in a specific amount of time, and it's got to be quote unquote big enough. That will mean probably very different things for different people here. Be curious about the others too. I think for us, if we structure it right, we could still live with a 50 million exit. That seems incredibly high, but in the returns we're trying to make over the amount of capital, if I look at a company that I would realistically expect can get to 3, 4, 5, 6 million revenue, sell for 20, 30 million, I probably can't really come up with a good deal, how I would invest and still make the returns that I would need for a fund. So that's a combination of a few points, but I know we have another few smart heads here that can add to that.
Yeah, I love the response, Tobi. And, just to like piggyback off of what you already answered, I think a VC scale business really depends on the VC that you're working with. So for example, Forerunner is operating at $1 billion fund. So what a VC scale investment looks like is $1 billion plus return profile to our fund, which, if you look at how much ownership a VC might buy, it's anywhere from 10 to 20%. Which gets diluted down over the course of a long 10-year history with which a fund might want to return an investment. That's a pretty sizable return. We're looking at a $5 to $10 billion outcome. And so, I always encourage entrepreneurs to think like, from the VC you're partnering with, what are the expectations that they're looking for? And then secondly, the nature of your business. Is it a type of business that requires capital to sort of fuel the growth? And if the answer is no, then maybe you're not necessarily in need of VC funding, which is, I think, a totally separate question of, can it be a VC scale business, and then does it need VC funding?
Yeah,
Fawzi, Lister, I want to push on Fawzi really briefly. You mentioned, for the people who maybe have less experience with investing, you mentioned that Forerunner is a $1 billion fund. From the perspective of a founder, how does that change what their experience might be in terms of the kinds of investments you would make and what your investing expectations are, and how many investments Forerunner expects to make out of $1 billion fund, just to kind of set scale and expectations?
Totally, it's all really great questions, and don't let me forget any of the questions either. So typically, a VC fund is all VC funds are structured very similarly. They're operating on a 2 to 4 year time horizon in which they want to deploy their capital. And in each fund, you might want to do anywhere from like 20 to 30 investments, depending on your mandate. And in those investments, you want to own a certain amount of each company. And the ownership is kind of directly correlated with how much you want to return. Sometimes owning 20% makes sense because you have to return a large pool of capital and you have to sort of account for dilution in subsequent raises. But in other times, you might want to own a little bit less because you're taking on less risk. So it depends on what stage you're investing in and then how much you want to own at the end of the day to be able to say, I am funding a venture scale business and this company will return my fund based on the parameters and the projections that we've set. And that changes across stage.
And to all the founders in the room, these are questions you should ask the investors that you're talking to, right? What is your goal? What is your job? How do you get measured? What are your returns? When are you going to say yes? When are you going to say no? Because I think these are exactly the right questions, and that, as you just said, everybody will give a slightly different answer. We will do 16 to 20 portfolio companies. Our goal is each company needs to have the chance of returning half the fund. So we need to make, if everything goes well, we need to make 25 million of a company that we invest in. So if we get a 25% ownership stake, we need 100 million exit. If we get a 12% ownership stake, we need a $250 million exit, and so on and so forth.
Thank you. Lister, I cut you off. I'm sorry.
No. I was just going to add a little bit of a different spin on it, because I think these points that were made by Tobi and Fawzi were pretty right on. I think about them a little abstractly because I think sometimes entrepreneurs don't necessarily know, care. I mean, like they shouldn't be building a business for an investor or a particular type of investor, an investor that is small, medium, or large. It doesn't matter. I mean, that's not how they start. So I think what can help an entrepreneur think about whether there's something scalable here is, first of all, am I addressing a big pain in whatever thing that I am looking at? Is there a big pain here in this problem that I'm looking at? Now, second, I do think that you do need to address a large market opportunity, and that's where it starts to become important to think about what is large. I think most investors will say billion-dollar markets plus are large enough for VC backable opportunities. Having said that, again, that's another point where I think entrepreneurs shouldn't think about whether their business is VC backable at that stage necessarily, but they should still try to address a large market opportunity. And then the last thing I would add is, can I have a unique solution? Can I have some uniqueness to the solution that I built to address this pain in this large market? And I think if you got those three things to different degrees, you're probably going to have investors. If it's yes to these three things, you're going to have investors somewhere interested in doing what in investing in your company.
Super important point. So speaking of investors then, and Lister, maybe I'll start with you. For founders who are thinking about going after VC funding, what are some of the metrics and some of the criteria that you look at to decide if an early stage company is ready for its seed round investment? And if there's any variation by industry, it's helpful to know. And I don't want to hold you to anything, but if you have any insights into like what some of the specific numbers might be that you look for with founders.
Yeah, for seed, honestly, I don't look for numbers much. I think at that point there aren't many numbers to look at yet. Or maybe you should talk to Tobi because he's got more numbers, being the German in the group. But what I do look for is product market fit, or I should say approximation to product market fit. So, and part of that is because I am a generalist investor, and I'm looking to invest in several different types of companies in different industries. And yes, of course, metrics are important, numbers are important, but I think most of us at the seed stage, there's not like it's a number that is going to get you. I think in general, how I would look at it is, do you have a solution that somebody wants to buy? And are the signs there that there's a market and there's a willing customer interested in paying you money to solve that problem? That to me is now. I think everything is nuanced, and the stronger your case, the stronger your numbers. The more of a case you can make, the more likely is that you're going to get investment and ready.
Fawzi, I heard you. I saw you nodding your head when Lister talked about product market fit. Is that one of your criteria as well?
Yeah, I love the points Lister brought up. You know, I think that, to just echo a few of his points, one is, you know, you're a great team in a big market. You'll hear that said over and over again by a lot of VCs. You know, if it's a $500 million market, oftentimes it might not return the venture scale outcome that we're looking for. So check number one. Number two is, when I'm in a pitch with someone, I'm often looking for, like, is there a founder market fit? You know, is there a compelling story as to why this company needs to be built and that this team is the right company to be building it? And at the seed stage, it's very much less metrics driven and very much qualitatively driven. I think the metrics come from what have we seen on the public side or private company side that might inform our decision on the seed round. And so, you know, as Lister mentioned, like, product market fit is one great way of or inklings of product market fit is one way of sort of understanding this. Are people coming back? What's your DAU over MAU number? What do your cohorts look like? Are they healthy? Are they not healthy? And just starting to demonstrate that there's, like, something there, that people are talking about you, that they're posting pictures about your product. Oftentimes, one of my favorite questions to ask at the early stage is, what have you learned in customer discovery? Because you're not really making that much money at the seed stage, but what you do want to demonstrate is that you've understood something about your customer that nobody else understands. And if you can communicate this to an investor, I can guarantee you'll get a seed round done pretty easily.
Awesome. You know, Sarah just asked the question, how do investors evaluate the quality of the solution, the problem at hand? Fawzi, I think you touched on this a little bit by looking to see how the market responds to it. Tobi, I'm curious, if evaluating solution quality is one of the criteria that you look at, and if so, maybe how do you evaluate that?
Yes, always through the customers or the potential customer's eyes. So a couple of things for us. So with most of the stuff that we invest in, we are mostly concerned about the commercialization side, much less the product or technology side. We don't do life-saving cancer research, and there's the question of, will this drug work in 5 years? Our perspective, and 90% of the ventures we get into, is whatever we can conceive of in technology, we can build. Just a question of money and time. There might be some 10% or so of deals where we look at and be like, well, will that AI really work, or will that really work better than XYZ? But that's pretty rare. So taking the lens of, our concern is, what's the commercial side look like? How quickly can you grow, build? What does the competition around you look like? What are the risks that could take your venture or your revenue stream and your customers away again once you've built it up? And with that said, to the question of how good is your solution, it's typically through the customer's eyes. Maybe combining with your earlier question, because we do pre-seeds too, really my only answer on what do we need on a team would have to be a full-time team, number one, and a plan. The plan can be written, can be a product, or could just be in your head. By the way, an important one, and I think especially maybe for Founder Institute and folks that go from there, when I say a full-time team, in my mind, I mean two things. One is, that doesn't mean 40 hours of work. That means your startup is everything. At least personally, I'm not good at, I also teach a class a couple of times a week, but I still work 40, 50 hours on my venture. Or I'm still going to keep practicing medicine with a clinical day a week, or your venture is 100% of your time. And I need, the team is in, not, my CTO will come on when we have funding. But that's me for now. I need a full-time team. And then ideally in the seed stage, I have a handful of customers. I have 5 or 6. And the reason is I can go back to them to start seeing early patterns. How long was the sales cycle for those? What do they consider as alternatives? And then to that question from Sarah, what was the value prop you signed up for? And how is the ROI now after 2 or 3 months? How close to the value prop that you were sold does the product actually get you? I think that would be my answer.
Awesome. Thank you. I'm going to switch gears a little bit away from knowing if you are, ready for investment to maybe something a little bit more general. There has been a lot of changes in the startup world over the past 6 months. So I'm curious for each of you, what's changed in your outlook today versus how it looked 6 months or even a year ago? And maybe Fawzi, do you want to start? I saw that little smile.
It's a really difficult question. I started, just for context, like I started my career off in investing in 2021. And 2021 was kind of this crazy year where every startup got funded at pretty high valuations, and there's value to that. And there's value to being a little slower and more deliberate with the type of investing that you're doing. And in 2022, what we saw was just a huge slowdown, a lot less funding in the startup space. And I think that was just more of a response to how quickly it was happening in 2021. So here we are in 2023, and it's a little bit like of a normal pace is what people are saying. Deals are getting done, but it's very clear that the best deals are getting done. We're seeing a lot of companies shut down or even return capital to their investors because they haven't found product market fit and are just taking a little bit of a more responsible approach. The way that Forerunner has always operated is with a thesis-driven approach. We have research areas that sort of are an umbrella to all the different areas we like to focus on throughout the year, and we refresh those and renew those on a semi-annual basis. And so to the extent that a company fits within our research and we're focusing on that area, we will probably talk to that company just to get a sense of what they're looking to do over the next couple of years. I'll just add one more thing and say that compared to 6 months to a year ago, most investors are looking for something maybe a little bit more responsible. There was a sort of sense in Silicon Valley era that people needed to spend a lot of money to gain customers. And now there's a sort of return to profitability and building with intentionality. I'd say I'd also just add that knowing when to push on momentum is a really important sort of key insight to us, right? When things are working, you kind of want to be hiring more, spending more potentially. But there is an emphasis on really managing cash flow and burn in this day and age.
Awesome. Tobi, how about you? What have you seen change?
Generally the same. I don't think we're very different than 6 months ago, but I would say there's always waves, always things that come and go. There's a big lesson learned, I think, in funding for me. That is, just like any sales process, your top of the funnel needs to be incredibly big to ultimately get the term sheets at the end. And here's the reason why. When our portfolio companies raise, we will typically give them what we would call an investor CRM of here 30 to 40 funds that should fit all of your criteria. They invest in your vertical, you are hitting their revenue threshold, it's the right size check, it's the right geography, right? These 30 or 40 should work. And we tell our founders, 2/3 of them will self-select out in the first 2 weeks. There's always the, oh, we're over-allocated in this market area right now. Oh, the partner who would typically lead a deal is already leading another. Oh, we need something more later stage now, or we need something more earlier stage now, and all of the above. So things change around a lot. The only thing I would say kind of the last couple of years, so more capital efficient entrepreneurs is probably overall right in the market than companies or entrepreneurs that needed a lot of capital to grow. That's always been our preference. I would say that hasn't changed a lot. For us, I would say it's mostly verticals that kind of come and go. Two good examples for the pandemic years. We stopped a good bit investing or looking into HR tech tools in 2020, 2021. There was so much noise with COVID that we couldn't tell anymore what's real traction, what's just a scarce work from home area right now. We didn't think we have a crystal ball. We said, we're not sure if in 3 years everybody's back in an office, working remote, if you're hiring across the nation or the country, or if you're hiring in your geographic area anymore. So we can't tell right now, let's just wait. HR tech is back for us. On the flip side, healthcare IT, which we did a lot of, is at least folks that sell to health systems or providers. We have a pretty hard time right now with what we've seen in sales cycles getting into hospital systems, what we've seen in cost pressure on these people. So I think for us, it's just more waves on which kind of markets, which technologies are currently interesting, but nothing groundbreaking, really different, I would say.
Okay. Two different perspectives. Lister, how about you?
I think what has changed from my perspective is not, it's not, is mainly the funding infrastructure. It's so I think if I think about entrepreneurship, of this flow of ideas, innovation, people solving problems, I don't think that has changed much. People continue to innovate at the same rate. People always seem to keep that steady. What tends to happen when money comes in and money goes out is the funding infrastructure around those entrepreneurs is what changes, what shifts. So one of the things, for example, has changed is the expectations that entrepreneurs need to raise money for 24 months at a time, rather than 18 months. That's a big change. People in funds would tell you, have enough money to last you this amount of time. That has grown. What we call an A, like whether an A is at $1 million or $2 million, I'm not 100% sure. That has changed. So I'm looking at the same companies that, maybe were around a year, 2, 3 ago. They're doing the same thing. Many times I find an entrepreneur that started at zero a year and a half ago, and then now is double or triple in revenue, and they're valued the same. Not because they haven't done great.
Well, did you just say they tripled their zero revenue?
Yeah.
Then you should have the same valuation if you triple zero revenues.
Well, but it depends on the valuation that they had when they started a year and a half ago. And that's what happened. Like some people overpaid. Now, was that because they overpaid a year and a half ago? Maybe, but that was the right price a year and a half ago. So there, I think that for an entrepreneur, the funding infrastructure has changed. And that, of course, has to do with the markets shifting, right? So I'm not sure that they are wrong or that the investors are wrong. It's just that the metrics, the dynamics are different. And that is what I see entrepreneurs being impacted and affected by. And that is, I think, the most significant change that I've seen that entrepreneurs, get puzzled over.
Super interesting. Well, we're trying to get some questions in. And no surprise, a lot of the questions have to do with the actual mechanics of pitching and raising money. So maybe I'll return back to that. The starter question of just think a little bit about the best pitches you've heard recently. What are the common elements to those great pitches? And on the flip side, what are the top mistakes you see entrepreneurs making when they're pitching their ventures? And Lister, do you want to?
Yeah.
Looks like you have some thoughts.
I do have a thought about this, and I hope Founder Institute does a good job with it, because I have a little pet peeve here. I think there's too much emphasis on pitching. There's too much emphasis on demo days. There's too much emphasis on showing off. And honestly, I think that is the biggest problem, when you worry too much about the pitch. I think when you understand your business and you know the business and you build it, it comes off. I mean, I don't think you need to over prepare. That time spent on presentation probably is better spent building the business. I'm not saying that you shouldn't prepare, but pitching, or the sort of the showy aspect of telling the story, I think is not that important, because that will, whether the business is solid or not, it will come off when you have a conversation. Might be good enough to get you a cup of coffee, but not much more than that, honestly.
I like that. Too much emphasis on the pitch itself. Tobi or Fawzi?
Well,
Fawzi?
I would heavily disagree with Lister.
Good.
We're just talking about we
Good.
always have to disagree. But no, actually, I think I might disagree in a couple of different levels. So, back to your original question. My first thought is, I do not like the same structure pitch deck for everybody. I would recommend entrepreneurs tell your story. Sometimes your story begins with the team. Hey, this is the team. This is what we did before. Here's a problem we realized in the market. Now here's how we're solving this. Here's how big the market is. and here's what we need in order to do it. Sometimes it starts with whatever else, right? But I think it's your natural story. It's funny, I told people a few weeks ago that probably for every company we invested in, I tend to remember one slide of their slide deck. There was something that stood out to me. Couple examples. Most recently, we closed a deal in Wilmington with a company called Approved Payments. I remember they had one slide early on the deck that said, when we interview B2B equipment sellers and buyers, 80% want to finance the equipment rather than pay cash. 10% of sellers offer financing. There's a huge gap. That's what I remember about Approved. There's another company in InsurTech, Slope Software. I remember they had a timeline slide that said, actuarial modeling software. Here are the players and the timeline when their software started. There's 5 that all started in the early 90s. Then there's nothing for 15 years, and then there's Slope Software in 2020. That's the premise of that company. The premise of that company is we're the first cloud native actuarial modeling software. And then they go from, here's why we think that has advantages to our customers. But so I think pitches are unique. I wouldn't follow a structure. I would naturally explain your story. The one part on, and maybe this goes to disagreeing, why I think a pitch is important. At some point, at least in institutional funding, you have to go through the partner meeting. I think there is something, as much as we all want to say we're data-driven and the like, I think there is emotional components to it. There are some hormones that start in our brain that either gets a partnership to start talking about the upside and here's how great this can be, or we all start talking about the risk and what could go wrong. And one will make us more likely to get on FOMO and say, gosh, we have to give them a term sheet. The other one don't. We're trying to all catch ourselves with data, but it's still a people business. You're selling people and you're trying to evoke emotions. That's one of the live pitches. The other part I would say that I think is important is you also need a deck that works without your own words in a pitch. Your deck will get forwarded a ton. Most of the time, we see somebody the first time, we ask them, send us the deck. And I will forward it to 5, 6, 7 investors in our fund that might be domain experts and say, you tell me, is this really a problem? Is there really not a lot of competition that does this? And at that point, they have to be able to read your deck without hearing you. So I think pitches are important. And I think there is 2. There's one, emotionally in a great way telling your story. And then I think there is that circulation deck that explains what you do well so that we can ask other people's opinion.
Fawzi, I'm going to ask you the same question, and maybe with the personal admission. Again, was a pretty mediocre entrepreneur once upon a time. And I remember one of my big concerns when I was pitching VCs and angel groups was coming across as maybe too amateur, not sufficiently pro. I was a first-time founder. Is there any particular kind of, gloss on the question you can provide for somebody who, maybe doesn't feel as comfortable in the space? They're worried about asking for too much money or too little money. They're worried they're going to drop a red flag without even realizing it.
Josh, you're too humble, first of all. not a mediocre entrepreneur at all. I think it's a great gloss to the question. And the way I respond to it is more just that everything's a learning journey. And I think that if you can show a slope of learning, then you have an investor who is going to be your champion. And I think engaging people early on and sort of narrating this arc of learning, this arc of company learning and personal learning is just like a very valuable thing. I meet people at seed sometimes and we don't invest until the Series B, and that's a 2-year-long process, but it's a 2-year-long process that I can go back to my team and say, look, he hit all his milestones, or like he surpassed all his milestones. And that's like a very valuable thing because we often take notes and we remember all the conversations and the decks that we see. And so just to like echo Tobi's point a little bit, like you should think of all your pitches and your materials as something that is going to be forwarded along no matter what. And so you should be crafting your materials in such a way where it's simple, but easy to convey a lot of information. And in terms of like getting tactical on how much money you should ask for, or if you're coming off as amateur, or maybe you have a question to the investor that you need to ask, like I'd say that everything's a conversation, and that the best conversations are the ones that engage the investors in the right way. It's totally okay to like not just be talking at someone for 30 minutes. I would actually encourage you to just like ask the investor's opinion, get their perspective on the market, because ultimately that will create a deeper relationship with you and them. And then to the point of the partner meeting, perhaps the most important part of a pitch, right? You're trying to get the entire investment team aboard. But the reality is someone's been in your back pocket and talking and hyping up your company this entire time. And you should just show up with sort of your best foot forward and give the same pitch that you've always been given, with the lens that someone might not be as plugged into the company as the person you've been talking to the entire time. So keep it high level and structure it in such a way where you're talking to a lot of people and engaging them in a conversation, rather than sort of like the long diligence process that you've just gone through.
One of the questions I wanted to ask the three of you had to do with follow-on investment strategy and how founders should be thinking about future rounds when they're raising their first round. And I'm also thinking, Tobi, about your point that, you know, you're not raising for 18 months anymore, maybe you're raising for 24 months or maybe even a little bit further. So maybe some of the advice that, you know, I might have heard or might even have given, you know, 12, 18 months ago myself, you know, raising kind of a minimum viable funding round. Is that even a concept? This is, by the way, Simon's question, so it's a really great one. Should people be asking for more money now? Is that kind of the recommendation? And you know, how does that change like how they structure their ask and how they structure their financials? I don't know. Was that a coherent question? Anybody want to take a crack at that?
I was just going to say, Lister and I just had a fight about that on a panel at Grappa-Palooza a week ago.
Oh yeah.
So maybe Fawzi, we'll let you take the first step.
Gosh, now I'm worried.
No, my point. I'll repeat what I said. My thought is that if you're later stage, you should raise for longer times. If you have actual revenues, a customer product already, you have a big threat that you might not be able to raise another round in 12 months, and that might just put your venture out completely. So in my mind, if you're later stage, you should raise with 2 years or more in runway. At the early stage, I'm not sure that's the right thing to do, because at the same time in this market environment, valuations are down too. So if I'm a company at 100K in revenue, I'm not sure I want to say raise 2 or 3 million, because how am I going to structure terms that still allow you enough ownership as the founder? That's an important one, by the way, for all investors, right? As we're talking about what are the ownership percentages, we care about what ownership you have in the company, because that's what keeps you motivated. And that's what will prevent you from, when your old boss calls you and says, by the way, I need you back and I'll give you $1 million salary a year, I need you to say no, right? And you're not going to say no if you only own 5% of your own company. I need you to own the majority and make an incredible payday at the end of the day. Yeah, with that said, I think on the earlier stage, I might try to go back to what's really the next inflection point I can hit. Could I get there with a 250K check, a 500, a 750K check? Could I prove that out? And I know I'll need to raise again. Or maybe I do it at, if I'm just starting out as a founder right now, I might go 250K, that'll allow me to operate for 6 months and prove 1 point out. And then if I can't raise in January or February again, I'll go back on some ramen noodle profitability where me and my co-founder work on $1,000 a month, and we haven't gotten the office yet, we're working from home, and I'll just keep it as lean as possible while I don't know how much runway I have. But I think in the earlier stage, I might raise less to prove out points, while in the later stage, I would certainly raise for 2 years.
And if I can sort of elaborate on the nature of our dispute, I guess last time we talked about this, like most of our arguments are usually subtle and kind of smallish, but for us, it can be meaningful and significant because, you know, we worry with these little things. But my point would be that while I agree with Tobi, in practice, entrepreneurs don't have the luxury to pick and choose exactly how much money they want to raise. That's number one. And I think early on, typically, an entrepreneur raising a new round probably most of the time should raise the money, as much money as they can. Because they never know when the next round is going to be available. If you cut it too short because you're too worried about valuation or giving too much of the company, and there are ways to get over valuation, by the way. But if you cut it too short, you could suffer from what is happening right now to many entrepreneurs. They just simply end up without runway. And most of the entrepreneurs that I see who are first-time entrepreneurs or who are rather raising their first rounds, what is going to happen is that they don't have 5-6 term sheets. If you do, then yes, you need to start thinking about, should I raise this much, that much? Where do I cut it? But most entrepreneurs are going to have one term sheet. And in that case, they probably should try to take as much money as possible, because getting too picky with how much money they raise could be dangerous. And that probably applies for different stages.
If I might add in a bit more perspective, Josh, I think there were 2 questions. So I'll try to answer. There was the follow-on, and then there was what's the minimum viable fundraise? And so just to piggyback off of everybody's points, I think if there's one thing I've learned in venture over the past 2.5 years, fundraising is often a game of momentum. And as much momentum as you can show, the better it will be, because investors will be really excited about what you're building. And so when you're going out to raise, oftentimes it's showing what that inflection point in your business is. And that's a conversation you have to have with your investors when you're raising money. You say, I think I can show this inflection point in my business by 18 months or 24 months. And I've structured my cash flow and my burn in such a way where I think I can get to this point by 12 months so that I can raise for the 18-month mark. And that's a conversation you need to have with your investor in terms of the projections you're showing, the numbers that you anticipate. And then they might push back and say, I don't actually think that's realistic. Like, I think that this is the case. And you'll redo your financial model, and then maybe you'll raise a different amount, or maybe you'll actually raise more because they get really excited about the inflection point that you're building. And so, like, the number one thing that I think an investor is set out to do is to help you raise your next round, especially us at the early stage. We can say we're going to help with hiring, helping build financial models, and we will. But the number one thing that we'll help with is to get you to your next round and to help you prepare and to build that story. And to that extent, like, we will participate in your next rounds through our pro rata rights. But it starts with the conversation of, this is how much I project that I'm going to burn, and this is how I'm going to get to my next milestone. And to do that, you need to like demonstrate this like deep knowledge of your product. So I know that's like loosey-goosey, but it's actually true, and what happens in the conversations when you're in sort of a diligence motion.
Yeah, that's helpful. Okay, I don't know how much time we have for more questions. I'm going to ask one kind of maybe fun one. I don't know. Let's see. Lister, you made the point about most investors only are typically getting one term sheet. I'm curious.
Entrepreneurs, you mean, right?
Pardon? Yes.
Most companies.
Yes. Most companies. Thank you. For each of you, don't break any confidences, but I'm curious, what was the last check that you thought you were going to write, but then didn't? And what changed your mind in the end before going through with it?
Oh, Tobi's fault for me. But I think
yeah, that hits hard.
oh yeah. I was saying Tobi.
The point is, we were going to go on into a deal together. Okay. And we, for the first time after 33 investments last month, just pulled a term sheet towards the end, like pretty close before closing. There's a company that ultimately it started going down. There was some metrics that didn't make sense. And we ultimately said, look, we just can't do it on these terms. But it was incredibly hard because we hated doing it on all different ends.
So yeah, so it's the same answer for both of us.
Okay.
I thought you were going to say he stole the deal away.
No, that has happened to me before. I'll tell you this, and that was one of the first ones. We went in, by the way, was it with Cofounders? I can't remember. Was it with Cofounders or not? Might have been with somebody else. Three investors in a term sheet, in a syndicate. And one of those pulls around and takes another term sheet, which I thought it was the lowest thing I've ever seen. If you're coming into a syndicate, it's one thing to compete. It's perfectly fine to compete, but to sign a term sheet, to be one of the term sheet participants, and to then pull another term sheet and win the deal and push the other two off, I thought that was low. Anyway.
It happens. And, you know, I think part of the reason that we might think about putting in a term sheet and don't is sometimes we just lose the deal or haven't moved quickly enough. But Josh, to answer your question directly, like I remember this deal a few months back, we were so excited by the repeat purchase behavior was amazing. The retention was incredible. And then we noticed, oh, wait, this doesn't have all the data we need. Let's ask for it. And then 2 weeks later, they'd send us the data. And then we'd be like, wait, they didn't send us all the data we needed. So we'd wait 2 more weeks. And initially, we were so excited by the business. But after 4-6 weeks of waiting for the data, we sort of ended up losing interest and moving on to different things. So that's an example of one where I think we probably would have written a check had we gotten all the numbers as quickly as we had hoped. But they had waited too long, and sort of like the fire that fueled our team was extinguished. And yeah, we didn't end up writing the check.
Time kills all deals.
Maybe one last thought of why these can happen sometimes, and what I would see as the biggest red flag of an entrepreneur early on. And Fawzi, I was meaning to follow up on your point too about momentum. That's important. My fear always is that people overstate momentum. And I would say the biggest red flag we could ever have is a knock on a CEO's character. Are they not honest? Are they not truthful to us? Are they overselling us? A lot of what you pitch early on will come back in due diligence, right? We'll click on that. And if there are things that clear-cut weren't true, that's out, right? Out and forever. We also had experiences as one of the kind of overstating momentum. This was just a few weeks ago. We got an email forwarded from an Atlanta-based investor about an entrepreneur we just had one conversation with. We're probably going to have a second conversation with, but we said in the first one, it's probably not quite our market. He sent an email to an Atlanta-based investor saying, hey, we're quickly closing up our round. Cofounders Capital wants to invest. He named another 5-6 VCs. That will take you out of probably everybody that we know, right? If you're starting to overstate something like that. The big reason for that is once we fund you, I think the biggest concern we all have is, do we have a CEO or team that is not open and upfront with us, that isn't an open book? If you're an open book with us, we can help you. If every board meeting starts with, everything is great, God, look at this revenue traction and here and up to the right, and we've all had experiences like that where everything was great, 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 until finally there was a board meeting that was, oh, by the way, we'll be out of money in 3 months. We're like, what the heck? Like, if you would have told us before, we could have helped. All right, then let's vote to shut the company down, right? So I think this idea of any knock on a CEO's character, honesty, you overstating some things, you being dogmatic on things, or not clearly saying, well, look, I don't know yet if that scales. That's what at least I personally like the best. If somebody is honest and tells me, these are parts of the business I know, I don't know how well this scales. I don't know what the sales cycle is yet. I have these and these ideas, but could be completely wrong. That's who at least I would love to work with the most.
Feels like a mic drop comment. Be trustworthy.
I'll do a quick, because I think Pete's question is awesome. I'll do this really quick. This is a 10-second answer for me. How should I evaluate potential investors? My thing is reference calls. I would reach out to every company that person is on the board of, or everyone they list on their portfolio page in that fund. We do it the other way around too. We would also say, when you're hiring somebody, I would choose reference calls over an interview. I could hire somebody that I've never interviewed as long as I've done enough reference calls. I think they're a lot more important. They will tell you what people actually do. In our mind, people never do a 180. What they have done the past 5 years, chances are it's got what they're going to do the next 5. So just call up all of the CEOs and you'll hear good and bad stories. Once somebody made dozens and hundreds of investments, there will be things too where the going got tough. And that's interesting to see how people reacted at that point. So reference calls.
Yeah, I would just add to that. at Forerunner, we really like to get to know our founders, and we want them to get to know the whole team as much as possible. And so we really value that. And part of that process is having them talk to founders who might be asking for similar things that another founder once sought. And, you know, oftentimes that's a selling motion on our end where we connect you with a founder who we really like and work closely with. Other times you should just ask for someone who maybe you don't talk to as closely. And I think that's totally cool too. They'll give you a sort of honest answer on that front. I would also add that you should have that conversation with your investor. Like, another one of my favorite questions to ask is like, what are you looking for in a partner? Because if we can't provide what you're looking for, like, then it doesn't really make sense to partner at least at this time. So, you know, for example, like Forerunner has a platform team that helps people hire and helps people on the finance side and helps people on the research side and on the comm side. So that might be something that an entrepreneur values at some point, but it also might not mean that an entrepreneur needs that at a specific moment in their time. So would really have that open conversation, which seems to be a theme of this panel, open conversations with your investor.
That's right. Well, we are at time, and I wanted to thank our panelists, Lister, Tobi, and Fawzi. This was a lot of fun for me. I know I learned a fair amount, and I hope that the folks on the call learned a fair amount as well. This is the first, as I mentioned in the very beginning, this is the very first event of the Raleigh chapter of Founder Institute. We are a pre-seed accelerator. Hopefully we'll take some of the good advice ourselves from here and make sure we're focusing as much on building the company as we are on building the pitch, and encouraging people to have open conversations with investors, whether they're VCs, angels, or otherwise. If you want to continue the conversation, I'm going to open up a Google Meet in just a moment that folks can join. It won't be a webinar, which means we'll be able to see each other. And if there's enough people there, I'll break us out into little groups and we can make introductions and talk about whatever entrepreneurship stuff we want to be talking about. And if anybody wants more information about Founder Institute, visit fi.co/Raleigh. And I put all of those links. There we go. Thanks, Greg. And I put all those links as well in the chat. Sarah, I'm sorry we didn't get to your question, but join us in the Google Meet in a minute. And again,
if I might add just one quick thing, if people want to reach out directly on LinkedIn or email, that's at least for me, I want to speak to myself, that channel is always available, and I assume for Tobi and Lister as well. So just wanted to put that out there as well.
Yeah.
And,
awesome.
Josh, one more thing to those that are on the call. This is our first event, but it's definitely not going to be our last. On July 11th, we'll be actually hosting our first live event, and Raleigh Founders gracious enough to host us. So there'll be many other people, hopefully from the ecosystem, that people will be able to rub some elbows with and ask some questions and get a little bit more intimate with, which we're looking forward to.
Awesome. Have a great evening, everybody, and I'll see some of you over in the Google Meet. Thanks again.
Thank you, guys.
Thanks, everyone.
Yep.